Welcome back to the channel. In today's video, we're going to be looking at 24 investing stats that you must know. Now, if you're anything like me, guys, stats are always interesting to see. Really the things that make you question or make you second guess what you're doing. So this was actually a list that was out a while ago from certified financial planners on looking at the logic in the interesting investing statistics. We're going to be going over them all and really giving you my input on them. So let's go ahead and get into this. So number one, guys, if you don't start investing until 45, which for me personally is right around the corner, you will need to save 3 times as much as starting at 25. Now, this, of course, is because of the logic of compounding interest. It has been proven when you wait or that 20-year gap, guys, you can make up an absolute incredible amount of time, which I've said it before and I will say it again. As soon as you start working, you should start investing, whether it's IRA, whether it's 401k. Put away 15% from the start, and you will be amazed with how much you have by the time you're 30, 45, 50, 60, even getting into retirement. If you literally do 15% from day one, when you start a job into any plan, rolling that over the compounding effect over the course of essentially probably 40 plus years is going to be just absolute insanity when you look at the numbers. So number two, 90% of actively managed funds underperform passive ETFs. Now, this is one that I've shared with you guys before. This is because of the fees that are associated with funds, which again, we'll get into in a little bit. But when you look at a fund, let's say like the VOO, the Vanguard S&P 500, it has a very, very low, I believe it's a 0.03% fund ratio or fee that is effectively to manage that fund. Now, if you look at financial advisors, most of them do have a 1% fee that is associated with that. Now, even looking at a lesser fee can still be a lot because some of them have annual fees, some of them have monthly fees, some of them have percentage-based fees. Again, this is a reason why a lot of the passive funds like the ETFs can really outperform. And it says here 90% of actively managed funds, again, underperform the passive funds such as the ETFs. Number three, 0.75 in fees equates to 20% smaller nest egg in 30 years. That is right, guys. This is, again, why a lot of the passive funds really do outperform the actively managed funds. There are not many managers that can beat what the ETFs or what the S&P 500 is really producing in the long term. Short term, you might see some gains. You might see some different kind of things that come along the way. Again, a lot of people that don't know anything about investing do not want to put the time and effort into learning it, which again, that could equate to a 20% smaller nest egg when you hit that 30-year mark. So number four, on average, women invest more conservatively for men. Long run, this is lower returns. The more risk you have, especially at a younger age, will outpace inflation, will continue to build much faster. Now, again, this is traditionally not saying it cannot change, or there are not a lot of women that do very aggressive investing. But overall, when we generally look at the population, that is the case. Number five, long-term assets stated that the time interests were near current levels. Treasury bonds lost 40% of their inflation-adjusted value over 3 decades. So over 30 years, guys, Treasury bonds have lost 40% of the inflation-adjusted value over 3 decades, which is kind of crazy. Incredible to see. So in August 2020, number 6, Fortune magazine published the 10 stocks to last a decade by December 2012. So 12 years later, the portfolio containing these stocks lost 74%, which again is absolutely crazy. So Fortune magazine having a huge miss with the guidance of the 10 stocks to last a decade. 1 decade later, your portfolio would be down 74% if that is where you're putting your money. Now, this is one of the reasons, again, going back to the nest egg, why I do not invest in specific stocks, guys. Now, again, you can hold a little, maybe a couple percent of our portfolio in there, but when you look at an ETF, again, that I go back to all the time, you have your risk spread across all the industries. You have your risk spread across a big caveat. And again, when you look at Warren Buffett, he said S&P funds, everybody should hold those. And I do agree with that wholeheartedly. Number 7, all economists agree that predicting a stock price is near impossible. Oh, however, only 59% of Americans agree with this. So you have the professionals that say it is near impossible to pick a stock price or predict a stock price, when Americans, who are the uneducated when it comes to the investing side, 59% only agree with that statement. Now, women on average earn 80% of what men bring home, which is kind of crazy to think. The equality is kind of getting there, but it still has a big deficit to go. Number 9, 40% of stocks fell at least 70% since 1980. That's considered catastrophic losses, and they have never been recovered. That is right, guys. And this is the reason why, again, the broader index makes a very, very good reason. Now, number 10, Vanguard reported that all mutual funds benchmarked to the S&P 500, 72% underperformed the index over a 20-year period. Let me say that one more time, because again, we talk about the S&P 500 fund quite a bit. So all mutual funds are benchmarked to the S&P 500, yet 72% of mutual funds underperformed in a 20-year period. Now, this goes back to Dave Ramsey always saying to pick good mutual funds, really stick with those mutual funds. The phrase professional investor is certainly a losing one when you look through the lens of history. When you're looking back, guys, again, mutual funds not outperforming the S&P 500 when you look back over 20 years. Now, most people expect to have their mortgage paid off by age 75. However, 21% of Americans still carry a mortgage by age 75. That is right, guys. Almost a quarter of Americans still carry a mortgage payment into and past age 75, which in my opinion is absolutely crazy. To see that you're trying to go to Social Security or fixed income with still having a mortgage and still carrying a mortgage. Now, number 12, the average retirement account generates less than $400 per month in passive income. That is right, guys. $400 per month in the golden years. When you're getting ready to retirement, that is what it is generating. Again, that is what you're using to offset or supplement what you're getting from Social Security, if Social Security at that time is still there, which hopefully it will be, but there is not any evidence that it's going to be or exist as it does what we've seen today. Number 13, between 1928 and 2013, the broad index of US stock increased 2,000-fold. That is right, guys. When you look at Warren Buffett, when you look at the Charlie Mungers, the US stock index has increased 2,000-fold. However, during that time, there are 20 times that it has lost over 20%, which we know in 2022, the stock market, I believe, was down 22%. Volatility wouldn't create as much fear if people realized how common it really is. So again, when you look at the longevity, when you look at a number of years, I mean, you're talking almost 100 years there. The price of stock, or the US stock, has increased 2,000-fold, which is absolutely crazy. As of January 2013, 16 people born in the 1800s were still alive, according to a research group, which of course was well over 113 years. With dividends reinvested, US stocks would have increased 28,000-fold during their lifetime. So if they would have put money in there, you would have seen a 28,000 times increase, which is crazy to think. Number 15, when asked how much saving for retirement, 53% of American workers said less than $25,000 is how much they have saved. 35% stating they had less than $1,000. We know this day and age with inflation, really living paycheck to paycheck is what a lot of people are doing, guys. It is very, very tough, but making sure that you budget and make sure that you really know where every penny is going to is up to you. It is your personal responsibility. So the average investor over a 20-year span in 2015 underperformed the S&P 500 by 6%. That is the reason, guys, why I say there's proven facts that the S&P 500 is a good fund. Number 17, women are more likely to get part-time jobs that do not qualify for a retirement plan. That is right. 30% of women age 16 or older had part-time jobs in comparison to 12% of men. So again, a little bit of a difference with not only having a job, but also having a part-time job. Now, number 18, we're almost done with this list, guys. U.S. entitled retirement program, Social Security, is based on what you earn in a lifetime. in general, with women making less than men, but also typically leaving the workforce about 12 years earlier. That is right, the Social Security benefits for women are a lot lower due to those two factors. Number 19, divorces do happen, but it's likely to take place in the first 7 years. That means your ex-spouse cannot claim the Social Security benefits that you have. You have to be married 10 years or older to get those benefits. Now, that I did not know when it comes to stats. On number 20, the greatest returns seen have been when people were expecting the biggest losses, which is kind of crazy. Single best 3 periods of returns turns out it was during the Great Depression. The best returns, the 3 years starting in 2009, when the economy and the housing market was in utter ruins, were the best returns that we've seen. 21, parents at least 61% of them prefer discussing finances with their advisors than with any of their children. That is right, guys. That is completely unsatisfactory by any means. You will educate your children on so many aspects: finance, investing, finance structure. This has to be a conversation you're having with your kids when they're young, even when talking about finance, talking about money as they grow up, as they get older, guys. This has to change. This is one of the absolute biggest things in America that I see, as parents do not share anything financial with their children. It's almost a hush-hush secret, nothing that is talked about. Number 22, hedge fund managers underperformed everyone for almost the last 10 years, which is crazy. That is not just in the stock market, but hedge fund managers also underperformed inflation as well in the United States. So 23, stocks rose 1,100-fold over the past 70 years, which is kind of crazy. And the final one, guys, most active traders garnered the lowest returns between 1992 and 2006. 80% of active traders lost money, where a majority of them, the other 19%, broke even, and 1% of traders between that time frame, guys, for almost that's 14 years. 14 years, only 1% of traders were profitable during that time, guys, which again is absolutely crazy. So, all right, guys, so that'll do it for today's video. 24 stats you have to know about investing and finance. It is really cool. Again, I love the stats. It's awesome to see. And again, it kind of makes you realize. So let me know in the comments which one you thought was the most interesting. And as always, thank you guys for watching.